Investors, welcome to the High Class Dividend channel. In this video, we'll dive deep on how to break the classical trade-off in dividend growth investing, having to choose between growth or income from our companies. We'll learn today how my own version of the dividend yield theory helps us acquiring our favorite high growth companies at a higher dividend yield, and why high growth and yield combined are an explosive combination to accelerate our dividends cash flow. But first, the disclaimer. This content is for educational and entertainment purposes only. I am not a financial advisor. Nothing in this video is finance, legal, or tax advice. Always do your own research and consult a licensed professional before making investment decisions. The agenda of today. To facilitate the storytelling, firstly, we're going to go through the classical definition of the dividend yield theory, how I adapted for dividend growth investing, why it is so powerful, and for the sake of being transparent, we are going to see also its disadvantages and how I manage them. Now, dividend yield theory is an investing approach that assumes a stock dividend yield tends to revert to its historical average over time. If the current yield is above its historical norm, that stock may be undervalued. If it is below, that stock may be overvalued. To get some visuals, here's a graph showing Visa's dividend yield over time. We'll notice it tends to bounce between a maximum and a minimum level. What a dividend yield theorist would do here is to buy Visa when it is scoring its highest levels of dividend yield, which historically impacts in price appreciation. Now, when the yield reaches its minimum level, this investor would sell his positions, believing there could be some downside potential to the price performance. We like very much the idea of starting a position at the peak levels of dividend yield, but we don't like sharing our shares at all. We want to compound our dividends to perpetuity. And this starts explaining how I tweak this strategy to better fit my investing approach. While the classical mode involves buying and selling, we'll stay with the buying part but disregard the selling completely. The moment our companies would be presenting extra low yield would be an opportunity for rebalancing, but this would be for another video if you are interested. So let's see how I do this in practice. Here's Parker dividend yield over time. First thing I'll do is change this graph to a version I think it's easier to understand. The blue bars above each year are the range of dividend yield levels this company has achieved during that specific year. The green line is my calculated target yield, and the yellow point is the current dividend yield for Parker, 0.93% at the moment I was recording this video. We can clearly see Parker is way out of my buying range, and this relates to the number one critic I receive when I talk about this strategy. What if Parker never reaches my target yield? I have two answers to that. The first one is that my target is fluid. It changes frequently. It could be that in a year from now my target could be much lower, but that's the bad answer. The good answer is that I am okay if Parker never reaches my target, because I have many other companies on my watch list that have achieved their targets. I'll be putting my money on them while I wait for Parker and the others. Talking about my watch list, here's a small portion of companies I'm seeing discounted now under this perspective. Actually, this moment is quite good, and I have 24 companies where I see bargain opportunities. Another question I get here is, what if none of the companies in my watch list are discounted? What would I do? I have to say this never happened before, and I think that would be very rare. Yet, I would still be able to sell cash-secured puts in order to earn income while waiting to buy the companies I'm watching. But I can explore this in another video if you like. If you have any interest in knowing more about my watch list and my process, let me know. Maybe we could make a monthly series about the current market situation and what opportunities I'm seeing. Let's go back to our example. I want to show you how powerful the dividend yield theory can be. We need to look at the dividend growth and yield together. Let's simulate how our income stream would grow over time if we bought Parker at our target yield, at the current yield, and factoring in the dividend growth rate. So, this is the development of our yield on cost based on the initial dividend yield. The most important message here is that buying at our target not only gives us an initial advantage, 2.82 against 0.93%, but this difference only increases over time. Both lines keep separating from each other. Whoever bought Parker now at the current yield will have to wait up to year 12 in order to reach our target level of starting yield. Another way of looking at this graph is at year 10, whoever bought Parker now would have a yield on cost of only 2%, while people who waited for the target level would be scoring 7%. We are accelerating our income because we are waiting for the best time to acquire this company. Again, if it never reaches my target, there are many other companies who do. Now we have learned how we break the income versus growth trade-off in dividend growth investing. We buy our favorite high growth companies at their highest levels of dividend yield. And before we finish, I want to share with you what are the disadvantages of this approach. I came up with two, and they both derive from the fact that we are buying a company that everyone else is selling. Actually, this is the reason why it became a discount opportunity. First point is there is some inertia to the downward movement that made that company discounted. Trend followers will keep selling the stock we are interested in, possibly extending the duration of negative movements. This until they see a sign of recovery and start buying it again. Now, here is just a matter of patience. Can you handle buying a company and seeing it red for some time? I don't see this as a real disadvantage. To me, this is just a temporary side effect. The second point, though, can be tough to manage. I call it contrarian risk. Here, we have to be humble enough and ask ourselves, everyone else is selling and I'm the only one buying. Why am I right and everyone else is wrong? Unfortunately, there is no secret formula to overcome this. It requires a lot of studying and due diligence. But I also like to factor in here the dividend safety of the companies I am analyzing, which, under my criteria, is a metric telling how certain it is that a company will increase their dividend payments in the next business cycle. It is a quite complex metric. It involves the dividend history from the companies, their fundamentals, and financial analysis. But we'll need a whole new video for this one. It's gonna be for the future. So that's it. I hope you guys have liked this one. Please leave a comment with some feedback or requests for future content. Would you like to see more of my watch list? Maybe my portfolio that I have just started to build? Just let me know. If you can, leave a like and subscribe, and I'll see you in the next one.